Yeah, it was a hectic week. We had a lot of meetings.
Oh my gosh. Yeah. Market, nothing happened though, right?
Quiet.
Oh, let's go. Japanese yen. First and front and center. Let's do this. Japanese center. Brownie. I hear that
Okay,
little guitar
Japanese
riff.
yen. What?
You don't want to talk about Japanese yen? So that's what all the cool kids are talking about, buddy.
Nah, I'm good. They walk back their comments. Nothing to see here. Move on.
Oh my gosh, dude. Are you even a wealth management advisor if you
Marcos,
don't do a carry trade on the Japanese yen?
the market is basically the same place it was a week ago. Nothing's happened. Move
Horowitz,
on.
let me ask you something. Do you remember the last time the market fell by 9%?
Nine, the US market?
Yeah.
By 9% in a single day? That would be
Or just, yeah, or 10%. I don't care. Just 9 or 10 or whatever it is. Where were you?
1987.
Where were you?
1987, I was 9 years old.
Did you just hold on? Let's try that again, my friend. The last time the market fell 9, 10, 11%, where were you?
In a day? 1987.
No, not a day, you punk.
What? I thought that's what you're asking. Where
No.
was I when I was nine? Nine to
When
ten
there was a
percent
period of days. When there was a
overall.
period of days.
That had to have been in 2022. It was 2 years ago. It was a warm August day. Um, no, it probably was a March day, maybe February.
Remember, it's not a day, it's a period of time, but it's okay. Yeah, eventually you'll get it. Yeah.
I was working for Events King Cats Foldus, doing Talk Your Chart with you. Not much was different.
Yeah.
Our
Life was
dog,
good. Life was good. Remember the good old days?
our dog wasn't even, well, we didn't have our dog yet, Bo.
No,
It's only
Bo.
been,
How's Bo?
Bo's awesome.
I know he is. Dogs are great, dude. Remember the good old days of like August 2nd when marks were at all-time highs?
August 2nd of this year, they were at all-time highs. I don't,
Pretty close.
no, it was like 3 weeks ago.
Remember the good old days of 3 weeks ago?
Still pretty good today.
I know, it's the whole freaking point.
Let's talk about it on our episode.
All right, let's just go. I don't have much to say. Let's get out of here.
What? You
You
always
know what? I'm
do.
done.
Did you have your coffee?
I'm done. Coffee? I don't need coffee. I am coffee.
Do you need me
Coffee,
to do the entire episode by
coffee
myself?
drinks me. Um,
Do I need to carry the entire episode?
uh, I won't let you do that. I
I
won't,
can't.
I won't
I
let you
can't.
get, I won't let you get away with that.
I did shoulders yesterday. I got wide shoulders to carry the entire episode.
Wow. Good for you.
Do you want to
Shoulders, huh?
start with Mrs. Sam?
No press? No press?
Well, not no with no dumbbells. I mean, no barbell, dumbbells only.
You say, hold on, no
No
dumbbells?
barbells, dumbbells only.
Yeah. What's wrong with that?
No, nothing wrong with that.
Yeah.
Shoulders feeling good. I can carry us. I'll carry
Okay.
you. I'll carry everybody.
I hope you had, I hope you had your protein.
You ready to begin episode 59 of Talk Your Chart, August 7th, 2024. Not a lot has happened in the last few weeks other than a lot that's happened. So let's get right to it. One of the big things that's spooked the markets has been the jobs number that came out last week. The number was 114,000 jobs, I believe, was how many were created in the month of July. And the unemployment rate went up to a whopping 4.3%. So the first chart I have here shows you the last few times where unemployment started so low, how much it dipped to and how quickly then it jumped, right? In 2018 and 2020, it jumped. In 53, it jumped. In 1970, it jumped. As you can see here in 2024, it's gone up, but much, much slower than those other periods of time. In addition, layoffs, while there may be a slightly higher, hires are still positive, real wages are positive, and the number of people looking for a job versus the people that have it that need a job, which was 2 at one point, is now down to 1.2. So I would argue that while things are slowing down a little bit, this is by no means anything scary. This is sort of natural. This has to happen, and it's fine.
So 2 points. Number one, shouldn't we all expect this because this was engineered by the Federal Reserve and that's what they said they were trying to do?
Yeah. Well, I mean, they don't want to make people unemployed, but they want to balance between not enough
I
people
disagree with you.
unemployed.
They do want to make people unemployed.
Well, not, we don't want all the people in the world unemployed. You need to have a balance between too many and not enough.
I agree that they want to thread a needle because full employment is one of their two mandates, but they've quite literally said we have to slow things down and that's going to result in some economic pain. And this is like the gradual pain kind of showing up. And hopefully people don't have to lose their jobs any more than necessary. But to your point, that's threading a needle, which is tough. The other, I guess, counterpoint to this is when I guess let's use the 1951 to 1953 one, although that is a long time ago. It's a hyperbolic move in unemployment there. When I don't know when it is because there's no dates on the x-axis here, but right before it shot up into the heavens, someone was probably making a talk your chart video saying, yeah, you see, it's like a gradual move up. So it's always gradual until it isn't. And it's a rate of change that matters, not what it currently is, right? So a 4.3% unemployment rate is still pretty darn low, but the rate of change ends up being what matters because once it gets going, it's hard to stop.
Yeah,
And
but go ahead.
and just how the hikes have a lagging effect, they take time to show up. Cuts are going to have the same lagged impact, right? That's why everyone's saying you guys are behind again.
It's possible. There's also things that were unique about the last report. A hurricane in Texas that disrupted a lot of things. You had a higher level of participation rate, people looking for jobs. So when more people are looking, you're going to have more people that can't find it. And I think talking to a client last week, she lives at a senior center. She was saying in the last few years, everybody that works there is there for a month and then they leave. And so, that was the problem that was happening then was there were too many jobs available. And so it was easy to just pick up, find another job down the street, get paid more and do it. We talked about it over and over on Talk Your Chart before. You need it to slow down. So when someone says, man, unemployment's going up, it's a little harder to find a job. I'm not going to leave where I am because I'm not sure how easily I'm going to be able to find something else. So
Yeah,
it's healthy.
I think. Shall we let's go Sahm Rule before we go ag. So I'm going to read this to you. This is to your point. Job cuts are low. And this is from our friend Torsten Slok at Apollo. The source of the rise in the unemployment rate is not job cuts, but a rise in labor supply because of rising immigration. That's the reason why the Sahm Rule doesn't work. Excuse me, the Sahm Rule doesn't work. Um, it was designed for a decline in labor demand, not a rise in immigration. Counter to that, our friend Michael Semblist also has some questions. According to Sahm Rule, when the 3-month average of the unemployment rate rises by more than 0.5% versus the lowest level over the prior 12 months, you're in a recession. So again, this thing measures the rate of change of unemployment, not the level itself. In this case, are things different? This woman, Claudia Sahm herself, said in a recent interview that there could be structural changes in the workforce that make the rule less reliable, which is the increase in labor force entrants driving unemployment higher. That said, she believes the Fed should already be easing to a clear labor market weakness, which is fine. We can argue whether they should be cutting already or not cutting already. I think they should not acquiesce and wait till September. And then check this. So on the other side of what our friend Torsten said, which is Sahm Rule, not a good indicator because of the structural changes in how unemployment is captured. Our friend Michael Furley is saying declines in job finding rates normally account for 3/4 of the increase in unemployment around recessions. In other words, there's nothing new about labor force participation driving up the unemployment rate during recessions. So we're going to have competing sides here. They're both looking to Sahm Rule, one saying, it is what it is. The rate of change is an indicator. Just because there's more entrants in the labor pool that are driving up unemployment it doesn't mean that that's a structural difference that makes this indicator not functioning. The other side says, yes, that's a big change, and we should not use it as reliable as an indicator.
Look, in June, the job number was 206,000. Obviously, that can get revised, and I think it did get revised in this
It
last
will,
report.
and it'll be lower.
It'll be lower, fine. But you had a very solid number in June. Everyone's freaking out about July. And what I read about the Sahm rule is that it had triggered in the last three recessions in 1990 or three recessions, 1990, 2001, and 2008. But in this period of time, none of the things that would normally trigger recession are happening. We have employment is still good. We still have real adjusted income that's positive. We still have a solid GDP. There's no data. Even she was saying, I'm pretty sure we're not in a recession. We might never be in a recession. So it works sometimes, but just because the article was giving the analogy, just because someone has an umbrella up doesn't mean it's raining outside. It's not proof that it's going to happen. It just had happened in the past.
Yeah, I like the indicator because it's like 10 for 10, what it is. And it's not something that tells you, it's not a leading indicator. It's concurrent. It tells you that you're in a recession. And I think unemployment is the most important piece. However, to your point, and this is why I also don't think it's proper, unless it's just early this time, which again, if it's early, then who the hell cares? How much of a helpful tool is it anyway? All the other things that the National Bureau of Economic Research use to tell you if we're in a recession, non-farm payrolls, real consumption, household employment, real GDP, real GDO, real personal income, real GDI, industrial production, real manufacturing and trade sales, all those things, while slowing, are not showing an aggressive increase to the downside or to the negative. Defaults aren't going up.
Right.
So I don't see it.
But what was the first thing that freaked everybody out? That was a sign a recession was coming. Inverted yield curve, right? Oh my God, the 10-year is less than the 2-year. That means a recession is coming. That happened like a year, 2 years ago. I mean, it's been that way for so long now, and nothing has happened with a recession.
I'm trying to pull it up. It's been almost 2 years since the 2 and the 10s inverted. Again, depends. Everyone likes to pick different curves, but if you look at 2 and 10s, it's been almost 2 years. And yeah, fair point. What good is it? But again, if a recession comes, doesn't it make it right? It was
No,
just
no, 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 no.
3 years early.
And you just missed a 40% rise in the market in the 2 years by your weighted. That makes sense.
You know what I did? I was in Connecticut last week, as you know, with clients, and my first chart was inflation with CPI and how it peaked June of 22. And then it's just come down consistently since. And I said, you know what that looks like to me? That looked like transitory inflation. And the room laughed, and I was so happy.
The Fed's not going to win that one, even though a lot of people would say that they were mostly right.
Yeah, transitory. Yeah, it's good enough.
You know what also has come? Do you want to switch topics or you have
Yeah,
something
look,
else?
so everybody can see it here. The Sahm rule that we're looking at here, who's named after the economist Claudia Sahm, it triggers basically once it hits 0.5%. And again, it's comparing the rate of change of unemployment over time. It is a very interesting indicator. It has been very effective. As you can see, each time it crosses that 0.5 path in the past, since 1960, you're getting the recession that it's trying to let you know that you are in. Each of the gray bars here are those recessions, right? The last thing I'll say about recessions is, let's just say we are in one. They're not all the great financial crisis.
Right.
Yields.
Yeah. Well, yeah. So what else has been coming down besides inflation is interest rates. Interest rates hit almost 6% at its high. Bless you. This is the U.S. aggregate bond index, the 10-year, hit almost 6% a few months ago. And as we got a light inflation reading a few weeks ago, there's a lot of money flying into bonds to try to, I believe, get in before rates come down. I think a lot of people are too late already. But interestingly enough, when looking at mutual funds and ETFs together, taxable bond funds were responsible for 90% of the net inflows in the first half of the year.
Of the negative flows?
of the net fund inflows.
Oh, okay. So coming, okay, gotcha.
Yeah. So of the 1,700 bond funds tracked by Morningstar, 74% of those funds had beat the benchmark index. So a lot to unwrap there, but my take on this is, and what we've been telling clients, you want to stick to your money market because you're getting a 5.15% rate or what at Schwab or maybe lower if in a different bank. That's week to week. That could change any point. I know that if you get a 3 month or a 6 month or a 12 month or 2 year CD or treasury, it's gonna be a lower rate, but you're locking that in. And we can't wait till the Fed lowers rates to see rates fall. They've already started to fall. They're down over 1%. The 10 year is now under what did I see this morning? 10 years now.
And it's at 3.9. So it popped
Right.
off the bottom. That was yeah, that
Seven.
was earlier this week. Yeah.
So it went from over 5 to now a little under 4. It's already started to move. So it's to the extent that you're trying to lock things in, you might already be too late to get the highest yields you've ever gotten. But the fact that so many of the bond funds have beaten the index is why we own active bond funds, because bond funds and bonds in general are not as actively traded. You can't just pull up a Google and see what a bond should be worth. Sometimes bonds don't trade for weeks at a time. And so that's the reason we're passive on stocks and active on bonds. Track records there.
Yeah, I think that's wonderfully put. I think we've beaten to death the idea that you should not look at your 5% money market and say that's perfect for the next 10 years, because that doesn't make any sense. The interest rate volatility has been hilarious to look at. We peaked at 4.9 on the 10-year, October 16th of 2023, fell as far as 3.7 coming into this year. That was a rally from Q4 of last year. Then we jumped over the first half of the year to 4.6, and now we're down to 3.7, 3.9. And this is just a market trying to deal with what's the Fed going to do, what's inflation going to do, and good luck trying to time these rate moves, similar to trying to time markets. It's going to be a losing game.
Well, I laugh because we've had lots of conversations with clients where when we show them the performance of their portfolio, the bonds are up somewhere 3 to 4% is what I've been seeing in client reports. And a lot of clients will look at that and be like, yeah, but I could have been up 5 in a money market. And I said, but this is only 7 months of the year. You're up 3 to 4, right? Like money market 5 is 5 annualized. So if you take it over 7 months, you're only in the barely over 2.5% range. And that's only if you had your money in the money market the entire period of time, right? Like we can't look back and say, man, in the last I should have done this or should have done that. It's too late. Like you just got to look at what it's done so far year to date.
Yeah, that's a mental accounting. You can't buy yesterday's returns, which is just tough. So yeah, from a bond perspective, hopefully everyone put all their money in the 5% 10-year treasury in October of last year.
You'd hope, but it didn't happen. The other thing that clients are going crazy about, and I've had a lot of people say this to me in the last few months, is I want to take all my money out of foreign stocks. I want to take all my money out of small company stocks, out of value stocks, put everything in the growth stocks in the US because that's where all the money's been made. And we've seen a huge hit on the Magnificent Seven stocks that are listed here, your Apple, Alphabet, Tesla, Meta, which was Facebook, and Nvidia. And in the last few weeks, the number was 1.5 trillion in market value has been lost by those companies. They're down quite a bit. The NASDAQ is in correction territory, down more than 10% from its peak. Small company stocks have been killing it. And interestingly enough, a lot of these names, even though they've dropped, are still expensive. I was reading that Tesla, as of a week ago, was trading at still 82 times their projected earnings. And Nvidia is still at 35 times their projected earnings. So some of the shine's been taken off of those companies, but they're still very expensive. And I think there's a reason that people are looking at them and saying, I just don't see the growth in there that everyone's expecting, and it's too high. I'm going to take some profits. Even Berkshire, Buffett sold his Apple stock. It did
Yeah,
well, so you sell it.
he also sold that several weeks ago before any of this
Right,
stuff happened, right? That's
right.
yeah.
But it's not that, I
But
don't think it's negative against Apple. I think he just said, I got made a lot of profit, I'm going to sell. And so if I'm owning these tech stocks, I'm saying I made a lot of profit, I'm going to sell. I'm not going to be greedy and look for more. So I'm not sure I can find anyone dumber than me to buy it after me to then see it keep going up and up and up.
yeah, and look, I think Warren Buffett, love the man. He's playing a different game than most of the people watching this are playing. And I guess the one suggestion would be to put the blinders on and stop pretending like you're Warren Buffett, because you're not, and we're not. Um, so the quickest way to make someone broke is have their neighbor win the lotto, or to try to pretend like you're Warren Buffett, and you're not. So, a real quick point here on your international piece. Usually, international markets trade at about an 85 or so percent discount to US markets. There's a quality premium that just exists in the US. So, that's normal for the international markets to not do as well, so to speak, relative to US markets. And right now, that's close to 67. So, historically, you're getting a ton of value by buying stocks that aren't the Magnificent Seven and aren't domiciled in the United States of America. The other piece is when you look at the S&P, and this is a little bit stale, but the point still holds. So this was from a week and a half ago. So before this kind of 9%, almost 10% drop happened, the top 10 stocks were trading at 33 times earnings, and their average is 20 times earnings. The remaining stocks, so the 490, S&P 490, was trading at 17 times earnings, and those are usually at 15 times. So while everything is, yes, a bit above average, meaningful difference between the 490 and the 10.
Yeah, we've
So
spoken how they led the market higher, and now they're part of the reason the market's had a pullback. Interestingly enough, did you know that since November of last year through the recent peak we had a few weeks ago, S&P was up 36% in basically an 8 to 9 month window. That's enormous, right? Like you would expect there would be some profit taking, a pullback, as you mentioned, average is 14% per year. Like this is all just, it should be happening. We can't go up and up and up forever.
yeah, I know. And this is like a 10% move, which we only got to 9.7, unfortunately, so we can't call it a correction. This is a healthy functioning market, right? And you should be almost happy that you get perhaps an opportunity to throw some cash at it or realize that markets are properly functioning. The issue is the whole this time is different is because it is, because this was disappointing earning results, recession fears, and the Fed behind the curve. The last time the market fell 10% was September 2nd to September 24th of 2020, when coronavirus, no new stimulus deal, and election fears were the this time is different. So this 9.7% drop down will be as meaningful to you as that 10.6% drop down is today. You
Well,
just got to
yeah,
give it 2 years.
but you and I have talked about this. If the year ended today and we didn't know what happened during the year, and you said S&P is up 10%, you would say, good year. Now, some clients look at it and say,
No, I
well,
would
it
say
was
I would say average year.
okay, average year. That's fine. That's fair. Right. But other clients look at it and say, well, it was up 19%, it finished up 10, so not a great year. What should I do? I'm scared. And it's like we're focusing too much on the short term. Average year so far, but
I know, but I
solid.
I'm going to defend the investor here. Long term, I hate that. I hate it. I hate the frame long term. It's silly. That's like having a kid and saying, "Look, it's fine. In 18 years, he'll be off to college."
But that's not how long the recovery is going to take.
What? No, I get it. But the whole problem with long term, whether it's 3, 5, or 7, or 10, or 2.5 years, it's made up of a bunch of short terms, and you got to live through those.
Yeah. So just leave your money aside. Don't do anything. Don't capitulate. Don't sell. Right? The people that sold last week or earlier this week when the market was getting hammered, only way they're going to make money is if they somehow buy in when it's lower. And if they're already selling when it only dropped a little bit, is there really much of a chance they're going to buy when it's even lower?
No. What's your next chart? Because did we go off the rails here?
No, we're done with charts. I'm still fired up about the people that are not happy with the 10% return for the year.
All right. Well, I mean, look, it's average, okay? And by the way, you know how many times the market's done 10% since 1926?
Zero.
Like once maybe. And it wasn't 10 flat. It was like 10.2. Averages are tough to come by, my friend. They're tough to come by.
Give me a 10 every year, call it a day, and I'll be happy.
Yeah, I know, I know. Um, here's something interesting. The world's running out of prime age workers, and that's folks aged 25 to 54. And this is something I talked about when I was in Connecticut with our clients last week. Um, that matters because demographics always win. And it basically means the population is growing faster than the number of people that can work, which is fine. And by the way, from a demographics perspective, I know you know this, while the US is not perfect, we're the prettiest pig because everyone else's demographics are even worse. And here's a public service announcement. Go have kids, please. Thank you. It's good for the economy. So let's kind of run out the path of what that means. And this is a little bit talking to the Magnificent Seven. No people to pay to work. So what do you have to do? Instead of paying people those wages, you or another company is going to have to pay another company to produce a machine for the output that isn't coming from the workers that don't exist. Fair. Okay. That money gets recycled where, BH? Into the S&P, into the market. By the end of the decade, that's estimated at $4 trillion per year in wages not paid to people, but to companies.
Well, this is and has Nick Murray written all over it, where he talks about the S&P is the biggest, baddest, strongest companies weighted by those companies that are set to prosper.
My
And
friend.
it will constantly adjust, not based on who the president is, not based on the economy. I mean, based on the economy and based on the companies that are in there and who's strongest. So as those tech companies that you talk about dominate the world, that will be what would dominate the S&P 500.
Yeah, look, as earnings are estimated on the S&P are estimated by the end of 2025 to be around $295 a year. Now, again, all those earnings estimates assume COVID doesn't happen, right? Because they're always going up each year and they'll revise them as necessary. That 295 per year, or the actual, let's use actual, this year annualized earnings as of end of Q1 were about 220 annualized on the S&P. That's going to be $1,000.
So you know what?
Eventually,
Hodl your S&P, hodl your stock portfolio. Just let it do its thing.
oh man. And then look at this, 1972 to now, the S&P, the index, up 44x, and earnings up 36x. Can't beat them, baby. You can't beat them.
Join them. I know what they say.
Something like that. Something like that. Innovation is
Alrighty.
good.
Let us hope for some less extreme events over the next month and that Japan doesn't do anything else crazy. And we'll be back.
Oh, Japan. Oh, forgot about the yen. Too bad. I guess we'll have to do the yen carry trade next time. That's what I've been doing in my kids' 529s. The yen carry.
Good, good. I'm sure that worked out well for you.
Yeah. It's been great. You got to borrow cheap, invest here and then there, but then you got to pay the hedge cost. It's fine. It's fine.
But except when interest rates rise, then you're in trouble. Alrighty. Have a good one.
Good to be back. See ya.
Yep.